Shaken, not yet stirred. This is an intro to my session at the Cycles in the City conference soon upon us in late May. We really look forward to seeing you all there in New York, live in person with cycle like-minded professionals in the field. So I'll be there. We have keynote speakers that will be there and many others that'll be joining. So look forward to seeing you there. And certainly during these interesting times, I'm framing the discussion in terms of what's been happening, but more importantly, what we should expect going forward. And on this James Bond-esque metaphor of shaken, not yet stirred, the big onus is yet. So clearly the shake has happened, but we have things like equity markets that continues to climb a new wall of worry, more to follow on that in a moment. But ultimately, like the well-known cocktail, having been shaken, but they are not yet stirred into a full structural downturn, which is the expectation, according to most of my industry peers, based on market structure, but also market cycles. And I'll add a few insights on that to come. For those of you interested in the subtlety and the detail, the drop in the martini is oil. And that's just a reminder that oil remains critical to all of us, whether you're trading it or not, because clearly it's the headline story that is providing the pressure point to markets here and now. If you'd like to read the full analysis that I share from month to month, it's available on Substack. You can just see the details down below. And of course, our monthly rollout with the foundation in these vlogs. Now, a big spotlight to our recent UK Foundation for the Study of Cycles affiliated event hosted by the Society of Technical Analysis, which is the UK hub of IFTA, the International Federation of Technical Analysis. We had a record turnout, more than 100. You can see the room full to the brim. And that's with my industry colleague and mentor, Robin Griffiths, and myself sharing macro cycles with several members from the FSC in the UK, and of course, like-minded professionals too. So if you want to hear more about that, there was a recording and I can share that with those of you who are interested, but more to follow in our Cycles in the City conference in New York, fast approaching. Now here and now, let's look at this relief rally that is happening in equities specifically as part of this risk back on trade, but it remains amidst fragility. And I liken it to that quicksand effect. You can build the tallest building in the world, but if the foundation's not strong and there's quicksand down below, expect it to fall like a house of cards. And this is also building into the asymmetry of cycles that typically are built in over time, particularly when there's a wall of worry that ultimately turns into a slope of hope. Both of those are Wall Street acronyms. Most people remember the first part, not the second. What goes up ultimately does come down, and that is certainly the behavioral contrarian expectation that we should be spot checking ourselves with here and now. So this is the move. You can see rocketing up as part of a late cycle elevated V-shaped recovery, basically shooting to the moon and potentially back again in time. But certainly major US equity indices have rebounded sharply, now trading above levels seen at the onset of we now know as this geopolitical event risk of the Iran conflict, approaching and now surpassing all-time highs across major indices with gains of close to 10%. So what we lost, we made back again following the recent ceasefire, which continues to be tenuous, but still headline important. Now, while this reflects strong liquidity positioning and resilient investor sentiment, clearly on face value, it also highlights a late cycle environment, which according to my work remains, where optimism and underlying fragility coexist. Now, what I want to do is draw your attention to the behavioral pattern, which gives you an idea on the sentiment that is driving this move. It isn't just bullish. There is some compounded bearishness there based on the 6-month distribution pattern that was. Clearly, that has now been neutralized or potentially negated. But if and when this relief rally exhausts, lose some momentum, and reverses with some follow through to the downside, then expect this pattern to be reactivated to the downside too, in what we believe to be a false hope pump and dump signal. I'll leave the chart there just for a few seconds so you can take it in, screenshot if you wish, but most importantly, have that big picture in mind in the context of this short-term V-shape recovery. The second point to keep in mind is that this isn't a one-size-fits-all. There is divergence beneath the surface if you look at breadth. And one of the well-known Wall Street insights is that breadth is the lifeblood of market sustainability. Therefore, poor breadth, less likelihood of the market rise to continue. And again, part of this quicksand effect. Now, what chart are we looking at here? This is the S&P 500 equal weighted on your general trading platform ticker. That's RSP, which is the Invesco ETF equivalent. And you can see here that while the actual absolute equity market has exceeded all-time highs, that's the S&P 500, that's the NASDAQ, marginally on the Dow, so there is some non-confirmation across the major indices. On the equal weighted, we have a lower major high. And I'm just going to quickly highlight that on the chart so it's clear. There is the major high early this year, Feb to March, before the Iran strike, which led to the ongoing conflict, which we're now in ceasefire fragile terms. And then the V-shaped recovery that followed, but has not exceeded that all-time high and is now rolling down from where it was. So this does reinforce the point that that ultimately fragility remains. It isn't one size fits all, and there are some divergences that we can identify, which ultimately tells us that we need to stay on watch. This can also be found on oil, which is clearly the mover and the shaker, interest rates with the inflation resurgence, and currencies, particularly the US dollar, if and when it starts to weaken further. Now, ultimately, this is something for us to watch, and certainly the changes will likely happen between now and the conference, but please continue to look at your intermarket analysis for a bigger picture perspective. Switching to market timing, there's a projected top into late May in parallel to the lead up of our Cycles in the City conference. So that's a big spotlight between now and then to continue to watch. And this chart, developed on the FSC cycle portal, is actually researched by one of our master working group members, and it's looking at an close to 80-year short-term cycle with 3 cycle beats from the past chiming into the prior all-time top of earlier this year, and then out into the future for the date just mentioned, late May, suggesting not only a projected top, but an exhaustion here and now likely to take effect with potential reversals to follow. Also look at the overbought nature of the market, which is true on the proprietary indicator here, as well as others elsewhere. Now, let's look at the mover and shaker, which has been oil. And again, whether you trade oil or not, this is an oil-centric market, clearly with the excessive geopolitical risk, the impact on oil in terms of a potential spike risk to 150, 200, which continues to be my expectation, not just because of the geopolitical risk, but because this is a new regime in energy markets generally. That's true of the oil underlying market as well as ETF plays looking at things like XLE. They already had a strong run up ahead of time. And remember, keep in mind, there's a commodity super cycle rotation at play too. So this is a general commodity inflation and scarcity story at play. Now, if we look at a previous chart I've spotlighted a while back, it is the oil fear index, otherwise known as OVX in terms of the ticker symbol, which is the equivalent of the VIX fear index of equities, but for oil. Now, last time I shared you this chart, it was hitting crisis levels at 120. Here and now, it's unwound back to 70, but remains elevated. And the key point here is that volatility spikes often precede major commodity price moves. And yes, you heard it exactly as I just shared it here and now. Volatility often leads price. And that's partly because we're looking at options positioning, i.e. future expectations of institutional hedging of extreme outcomes. So ultimately, you're looking at future expectations here and now. And in price terms, that is the equivalent of a plus 35% positive or negative monthly price swing on oil. So oil can really move and shake as and when it chooses to in this new volatility regime, which we remain in. And the quick point I want to make here from a geopolitical headline point of view, while ceasefire headline stories remain and still fragile at best, keep in mind that the energy travel choke point of the Strait of Hormuz is not only closed, but there's a double blockade here and now. So clearly that's going to create supply disruption and with strong demand holding likely higher prices ahead. And this is what we're seeing reflected in the volatility spike that, yes, has eased, but is still elevated. And then the most important chart is the historical chart on oil, inflation adjusted. Again, this is one shared before, and I'll feature it in New York because it's just so important. Big picture, but also there's all kinds of useful insights in terms of past patterns that are likely repeating here and now, real price perspective in terms of the reality of a spike risk to 150 and 200, and then lastly, the cycle regime. Let me just quickly run through that. The historical potential rhyme pattern is that we not just get a spike, which you can see oil has done several times before and is currently doing it here and now, but that we get a double shock spike pattern as we did in the 70s. So if you run your eye to the left of this chart, look at 1973 first shock, Yom Kippur War, and 1979 second shock, Iranian Revolution. That is likely what we are in the midst of here and now. Now, back then, we had drawn out one of the early long-term cycles averaging 12 years. Here and now, we're only mid-stage. So regardless of the headlines, upside surprise on oil remains, and we likely have a new volatility regime on an elevated new oil floor. That's the headline insight here on the chart. Now, I've received some notes from FSC members and master group peers asking the question on this idea of a new normal for energy globally and what that means, with all kinds of nuances. I'll highlight a few. One, the International Energy Agency, which are the world experts on energy, have actually said multiple times that this energy shock is the biggest ever. So that's the first point to keep in mind. So while I'm making historical comparisons, I'm only focusing on the pattern, but not the actual event risk. This time is super different because we just haven't experienced anything like this before. Everyone's been focusing on the Strait of Hormuz as being 1/5 of the energy choke point in the world, but keep in mind that the energy infrastructure of the entire Gulf has been hit or damaged, and that will take time. And clearly that has disrupted markets. Yes, there have been some overrides and some workarounds, but disruption remains. The other point I got is, what about sustainability and how that can pick up some slack? That's a medium to long-term play, which is not active here and now. And the third and last point I've received questions about is, well, what about energy reserves? Different countries have sufficient reserves, like the US and even China. Keep in mind, we're trading global oil markets, and there are global economic ramifications like inflation and economic recession, which clearly affect us all, regardless of energy reserves. So there's some of the talking points I wanted to share, why this chart is super important from a big picture perspective in terms of the double shock likelihood. Also just making the point that this time is super different still in terms of the shock, and the cycle regime, which is currently mid-cycle. Let's close on some commodity setups. Keep in mind what I've been saying, that this isn't just an oil story or even a geopolitical Iran strike story. This is a commodity rotation, late cycle from financialized markets to commodities, ultimately from a moment of greed where we are trading all the different investment opportunities available, to a moment of fear, which is typically scarcity driven. And that is seen in the rotation that is currently still in play. Commodities as part of super cycle, now broadening that rotation from gold in terms of monetary stress to energy in terms of supply side disruption, but also now into agricultural sector, i.e. food, and related farming practices, and ultimately consumer inflation being the next shoe to drop. And this is all part of the inflation risk ahead, echoing the 1970s. Again, another historical rhyme from the past, where we get structural supply constraints colliding with rising global demand. So this is the story at play. If you look at the chart on the top right, you can see that's the ratio of commodities versus equities, which is rotating in favor of commodities. That elastic band effect has been stretched and now snapping back. And the bottom right-hand chart is inflation now versus inflation in the 1970s. And you can see the close match, which suggests a resurgence into this year and beyond. Now, I want to flag gold because clearly that is still key, both in terms of its outperformance for the last few years, double-digit returns in terms of the underlying market, triple-digit if you've been trading or owning the related mining stocks. But gold has unwound from super overbought conditions. We have also seen a shakeout in ETF flows, as well as a high beta effect on miners, which is expected as a high volatility proxy of the underlying. But the long-term trend remains intact, holding above its 200-day average, despite coming under tactical pressure after a 25% peak to trough drawdown. And one of the macro reasons why that has happened is because interest rates is now markedly up. And so the opportunity cost between owning gold and having exposure to rates is now holding. Nevertheless, gold remains a portfolio diversifier, and it's best to own some of it. The World Gold Council recommend 5 to 10%. And if you're looking to actively risk manage, look at those key levels, the 200-day moving average at 4,100 or thereabouts, as potential levels to reassess. Now, to close, key insights based on the shaken but not yet stirred metaphor. Relief rally amidst fragility in equity markets and risk assets in general, but that fragility is also underlined by divergence and the cycle projected top into late May, aligned with our Cycles in the City conference in New York. So look forward to seeing you there, but also be poised for those market moves as they unfold. Oil remains the headline story, not just in market terms, but clearly in geopolitics. Ceasefire in play, yes, but Hormuz is still closed, double blockade. And what that means is oil spike risk continues not just to be active, but likely heightened. And we can see that by the elevated fear index of OVX holding near 70, likely to resume back to 120, that crisis level that I've shared with you previously. Remember, geopolitics aside, and even oil aside, this is a commodity supercycle rotation story with precious metals expressing the debasement effect, energy disruption, and now food inflation risks. The best guidance I can share just in terms of hedging and managing that risk is gold. That remains an important portfolio risk diversifier, as just mentioned. Yes, you can trade it, but ultimately, if you just own it, 5 to 10%, that will likely fare you better for the medium to long term, particularly as markets continue to be volatile. And if you want to actively, tactically manage it, you can do, but just differentiate between trading and portfolio diversification. That's it from myself, from William, global cross-asset tactical strategist as part of my work at RW Advisory, but also a development director at the Foundation for the Study of Cycles. Separate to that, I focus on a market mind approach with behavioral finance and neuroscience. And there's lots of education and thought leadership work that I'm involved in, along with organizations like the International Federation of Technical Analysis. If you'd like to stay in touch, please shoot me a message on my FSC email, just highlighted there on the right, or contact via social. And if you'd like to read more of my work, find it on the Foundation or on Substack for those of you who'd like to stay in touch and stay engaged with latest insights. Thank you very much. Welcome feedback or questions, and please hit the like, share comments, which I do read and respond to, and look forward to seeing you all in New York in the weeks ahead for our Cycles in the City. Thank you, and best wishes with navigating the cycle ahead.
Cycles matter because they show us the future. Nothing else shows us a future path. Nothing that I've ever found in over 60 years of doing this.
The foundation is bigger than markets, right? It started out bigger than markets. It's still bigger than markets. It's bigger than us.
There is no such thing as a black swan. It is merely a cycle that was not forecast or anticipated.
To me, it's huge. If I can get a glimpse of the future, just a little bit of the future, I'm way ahead.
I think that the Foundation for the Study of Cycles has a role to play in both bringing technology to the world, but also really emphasizing agency and human agency.